Good evening, early birds. We're going to wait a couple of minutes to let everyone get in the room before we start. Manu, thanks for being here, bud. Appreciate the support. Scott, you as well. Thanks for being here. We do have a Q&A, so feel free, as the webinar progresses, if you have any questions, feel free to just drop a question in the Q&A. We'd be happy to address it toward the end. It's only one after, so we'll give everyone some more time here to get going. We promise to be respectful of everyone's time tonight. I know everyone, has families and careers and whatnot, so we definitely appreciate you spending some time with us tonight. We'll give everyone just a couple more minutes and we'll get going. And this should take 35, 40 minutes tops, depending on how many questions we have. Okay, we'll get going tonight. Again, thank you for being here tonight. My name is Ryan Johnson. I'm the Director of Investor Relations and Investor Education at Gen Wealth Capital Group. Before we start and dig into tonight's topic, a little bit about our company, our team. Like I said, I'm over Investor Relations and Construction Management. Juan is over Asset Management, and he's more acquisitions focused. And Brian, he's more underwriting and finance focused. We're all Houston based. Houston is our primary market. We also invest in Austin, Texas. But we all live in Houston. The company highlights, we have $200 million of transaction volume. A transaction volume means we bought an asset, for X amount of money and we sold it for X. So that would increase the transaction volume. But we have acquired 1,680 units since 2016. Like I said, we're primarily focused on Austin and Houston right now, but we have owned deals in Phoenix and DFW as well that we exited last year. We have 5 full cycle deals, either as the lead sponsor or as a JV partner. We specialize in Class B and C workforce housing assets. So tonight's topic is, investor decks and underwriting assumptions. And we're going to kind of discuss what to do before you even start looking at deals, what information to pull from these investor decks and how to make heads or tails of it. I want to briefly show you on a live underwriting model how some of these basic assumptions are going to affect return profiles. And lastly, I'm going to give you like 10 or 15 questions that I personally ask sponsors before I invest in their deals, because I am an active investor and a general partner, but I also do invest passively, as does Juan, as does Brian. Okay, so before you start investing in any deals, you have homework to do, right? If you're gonna invest your hard-earned cash into any asset or into any investment, I suggest you get at least a baseline education of that investment. you should choose your target markets, right? One of the benefits of passive investing is that you can diversify your income, let's say into real estate, but you can invest a little bit in Houston, a little bit in Austin, in Phoenix. You can pick a metro that you like and find groups doing exactly what we do in those metros, and diversify geographically as well as diversify into different assets. Maybe you like apartments, maybe you want to do some self-storage or some car washes, lots of different options. So you can diversify away from, let's say, traditional investing in a mutual fund, or if you have extra cash, but you can put it in different asset classes in different cities to diversify your wealth. You should understand your risk profile, right? Or do you want the least risky investment or the least risky position in an investment? Or do you want to higher risk, higher return situation? You should know if you're accredited or not, because if you're not accredited, you should only be looking for 506B deals, versus if you're accredited, you can look at Bs and Cs. Just a primer on accreditation. If you're single and you make $200,000 per year for the last 2 years and plan to keep doing so, or if you're married and combined you make $300,000 per year and continue to do so, then you're considered an accredited investor. Likely, if you have $1 million of net worth, not including your personal residence, then you're also an accredited investor, right? So that's going to open up the options to you. However, if you're accredited and we have a 506B deal, and you and I have never had a conversation before, and there's no documentation of that conversation, unfortunately, you can't invest in our deal. So 506B requires a previous relationship that's documented somewhere, versus a 506C, we can meet you at Starbucks and you can immediately invest in the deal. And I will answer all Q&A questions toward the end here. Okay, so education. Where do you get the education from? There's an abundance of free education, all online or in person. I strongly recommend books, blogs, podcast, webinars like you're on tonight. You check the box today by being here. Thank you for letting us educate you. But what helped me the most after I started reading books and blogging and trying to understand the basics was looking at real deals, right? So I started getting deal flow in Houston. That's where I wanted to invest in my first deal. I started attending live webinars, trying to understand the business plans, meeting the sponsors. And that really helped me grow, even though maybe I wasn't ready to pull the trigger quite yet. When you're new at something, you may want a couple of rounds to be comfortable. And so I watched a couple of deals. I ended up not investing in those deals. And then when I was ready to invest in the deal that I liked, I had already been through the process multiple times, looked at investor decks, looked at the contracts and whatnot. And so it was a comfortable position for me. I didn't feel like I was doing something completely new. There are numerous ways to network in the space, whether it be virtually like tonight. There's virtual meetups, there's in-person meetups. Pretty much every night in Houston, you can go to a real estate in-person meetup. And I strongly recommend that you take advantage of those opportunities. It's one thing kind of meeting virtually, but when you're around people in person, to be able to shake their hand, maybe have a bite to eat or have a drink with them, is definitely going to strengthen the relationship. There are numerous coaching programs to do this type of investing actively as well as passively. Happy to kind of introduce you to some of those. And lastly, we don't know your individual tax situation. We are not CPAs. We are not tax experts. We can give you basics on taxes and real estate, but you should discuss with your CPA and let them know, hey, I'm thinking about putting some money into some passive real estate opportunities. How is this going to affect my tax status? And if they have zero idea what you're talking about, then maybe it's time for a new CPA. I'm trying to get this Q&A off my screen here. Sorry. Okay, so that's stuck on, but we're going to roll with it. So, markets. Like I said, one of the benefits of passive investing is that you can diversify your investments across multiple cities passively. You don't have to be there. You don't have to check on the tenants, but you do have to pick the markets, right? So we prefer markets greater than 100,000 citizens in those markets. We like to see consistent job growth. We like to see diverse economies. We don't want just a one horse, one trick pony type of economic drivers, where if that economic driver is hurting, then the entire city is hurting and your tenant's ability to pay rent is also hurting. We want it to be landlord friendly. If we have a non-paying tenant, we'd like to get them out in 60 to 90 days versus a year. And we do not invest in assets in cities that have strict rent control. Similarly, COVID restrictions, that's a no for us. I mean, we all saw how, certain, local or state municipalities completely blew up their economies during COVID. We'd prefer to invest our money into, people with a little bit more common sense restrictions on the COVID side. Eventually, when you pick a market, let's say you pick Houston or pick Austin, and you start getting some deal flow into that in from those markets, we suggest you research, like if you're going to look at an apartment deal in Houston that I'm giving you, you should try to understand that little pocket, because like Houston, just like any metropolitan area, is going to be very pocket specific. Some pockets may be super established and great. Some pockets may be up and coming with the potential for higher returns, but you may have to deal with some headaches during the whole time. And some pockets may be terrible. And there are plenty of, resources online. We like to look at crimemap.org. It's a really good crime map. It kind of color codes everything. You can even filter by the crime. So we try to stay out of high crime areas. That doesn't necessarily mean we don't look at assets that are in, let's say if an area is turning, it may have a little bit more property crime than the established area where there's only $1 million houses, right? That's to be expected. But strongly red or strongly purple on that crime map, we try to stay away from. And lastly, we're looking at workforce housing assets. So we want a median income, right? So our median income is going to be 50 to 65,000 ish around that area, because especially right now with interest rates being as high as they are, the buying a house right now in the Houston MSA at a 7% interest rate is just not very affordable. And so our assets are going to service the people that are in that median income in the 50 to 65,000. That's our target demographic. Okay, and lastly, you need to know what your goals are. What are you looking for? Are you a retiree that needs to live on the cash flow and needs monthly payment? Then maybe you need to look for a deal that has a higher cash yield. Within the specific investments, they may have multiple shares. Like for instance, our last deal, we had a Class A share. Within that Class A share, you got paid monthly, you got paid first, you didn't get any upside in the investment, right? So you just got a 10% monthly payment. And you got paid first, so you were in I guess you could say, the safer position, but there was no opportunities to make 20% average annual return. Your return was going to be flat at 10, but if you want the safer position, you should know that going in. You should know your hold time, right? If you want to try to churn out your money and recycle it as quick as possible, maybe getting into a 10-year project is not going to be the right project for you, right? So you should know that going in and have your goal set. Do you want like a higher overall return? Or do you want a lower, safer return? That goes the same with risk profile, right? Do you want a stabilized, brand new asset in urban core Houston? You may expect a little bit lower cash flow, but it's going to be stable. You may expect a little bit lower equity on the back end when they sell it, but it's a stabilized asset and it's going to a little bit less operational risks. Versus in a development deal, you're going to have execution risk in a development deal. And you're going to have an overall higher return, but you're going to have zero cash flow throughout the whole period. And so you have to know your risk tolerance. If you're going to want to take the bigger risk, like in a development deal, and you could potentially double the returns, then you would get a stabilized asset. But just know that going in, so you know which assets to look for. Are you just looking to park money? We have people call us all the time. They're looking to roll a 1031 into any type of open deal that you have, and they're looking for the depreciation. So it depends on your situation, on your timing, right? You need to understand your timing of how long you want to be in a deal and what is your primary goal. Is it cash flow? Is it returns? Is it the losses? Know that going in, and you're going to have much more clarity on selecting an investment opportunity. Meet the sponsors. I can't harp on this enough, to meet the sponsors. I mean, you want to invest your money with someone that you like and you trust. And I would say a strong way to get these answers is referrals. Right? If you already know someone investing in people's deals and they've had a really good experience, get their names, get on their list, especially if you like their market. There's no shortage of general partners and sponsorship teams on social media and Google. Go to the metro area, Google Google, multifamily operators in Houston, Texas, you'll probably get 5 pages of people. Go sign up on their email list. They're probably going to give you a call, set up a call with them. And it's important to get to know the people that you're going to invest personally. I understand these investments very well, but if I'm going to invest passively $100,000 into someone's deal, I'm going to set up a call with their team. And networking, if you can meet the people out in public at a networking event, that's even better, in my opinion. We do have networking events one Saturday a month over in spring in the morning. It's like a lunchtime at a barbecue place. Happy to send you all the invite. We also have happy hour in the Heights every month. If you live in the city and you prefer to do that, it's just like basically cocktails with the team. Real chill atmosphere, no sales. It's a get to know you, not even education at the happy hour. It's just kind of a get to know you, meet and greet type thing. So investor decks, sometimes I personally think these things are a little bit too long. They're full of information. You're going to get this investor deck. It's going to be like 40 pages, right? It's often going to have some type of team intro with the track record and everyone that's on the team. It's going to have a pretty detailed market overview. So these investor decks are good for that. It should have a very detailed overview of the asset and of the business plan. And in my opinion, it should have all the assumptions on a page. Sometimes they don't, though. So these are things that you should ask for. And they should have some type of sensitivity analysis in there. And by sensitivity analysis, usually an operator is going to go in with a base case scenario, but usually there's some type of table to say, okay, if we miss these metrics by this much, maybe this is what the returns are going to be. If we exceed them by this much, maybe this is what the returns are going to be. And so usually there's some type of range. Sometimes lately I'm only seeing a range. So I think it's great to ask, like, hey, I see this range in here from 13 to 16%. Does that mean your base case scenario is in the middle? And it's just to see what they say, because most likely that's what it's going to mean. But I like to ask questions and tough questions before I'm going to invest my money with anyone personally. So your goal when looking at deals is just like my goal when looking at deals, right? You need to weed out the deals very quickly. You need to know the time frame you want to hold it. You need to understand your own personal financial goals. You need to understand your risk profile, and you need to understand your markets. The more specific you can understand about the market, like if you live there, great, you should already somewhat know the market, right? And you need to be asset class specific, right? If you're looking for a new construction deal, go out there and look for developers and new construction deals. If you're looking for a value add deal, look for value add groups. And there are some groups that offer both investments. We're working on an investment in Conroe right now. It will be our first large development deal that we're partnered with some bigger developers on, and we're looking forward to share that. But our bread and butter is existing multifamily assets. So we're going to get into a little numbers here. We're going to just do high level. And on a high level, the purchase price of any asset is determined by the NOI, or the income of the property, divided by the cap rate. And there are only a couple of ways to increase the net operating income. You got to boost the income, or you have to reduce the expenses, right? And you boost the income by increasing the rent, by increasing the fees. Maybe you charge pet rent, maybe you charge a Wi-Fi fee if you install Wi-Fi. Maybe you start billing back for utilities if the owner didn't do that previously. But any way to boost income to your property. And reducing expenses, you're hiring, you're running efficient operations, you're controlling your R&M, you're keeping your tenants there and happy. Those are going to reduce expenses. Another way to boost the income or boost the values of these properties is maybe not in your control, and it's the cap rate, right? And cap rate is, we're not going to get into the definitions of cap rate. I really want to focus on that you understand how cap rate affects the deal metrics, not necessarily some long definition, right? But in a nutshell, if I'm going to sell a property at a lower cap rate, I'm going to be asking a higher price for it, and I'm going to sell it at a higher price. If I'm going to be selling it at a higher cap rate, then that cap rate, it's almost like an inverse relationship. Then that asset price is going to be lower, right? And so if anybody that's been around multifamily for the last 2 years, you've heard compressed cap rates. That means just because the demand was so high that cap rates stayed artificially low. The market stayed low, the demand was high. Rent growth was out of control over the last 2 years. So if you combine that out of control rent growth that really boosted income with that artificially low cap rate, people were hitting home runs every couple of years, including us in the Dallas deal and the Arizona deal, right? We bought it, we boosted the income significantly. We took advantage of the market and the low cap rate, and we sold them, and they were absolute home runs, right? But now in 2023, with the with just interest rates super high, cap rates have kind of unwound a little bit, right? And they've increased, especially in the C and the B class space, even the A class space. They've increased. And so that's just going to make the value of the property, even if it has the same income, it's going to make the value of the property less. Okay, so assumption. So you're going to get this 50-page investor deck. Now is the time for you to take your pencil and you're going to go through that deck. Or if it's online, put it in editor mode, on the PDF editor mode, and just circle some numbers, right? You're going to want to know what the going in cap rate is. It's kind of an ongoing joke. Like if I see someone that I know that's doing a deal in Houston, I'm going to log into their portal. I'm going to download their investor materials. Funny, a really good friend of mine the other day, I logged into his portal. They have a deal going right now in Dallas. And he texted me and he's like, man, quit snooping on our stuff. I know you're not going to quit wasting our time. I know you're not going to invest in our deals. And it's true, right? We want to understand the assumptions that they're seeing to say, okay, or what are they assuming for rent growth? What are they buying this? What is their going in cap rate, right? If they don't, I think personally that sponsors should put the going in cap rate in the materials, but sometimes they may not have it. But that's very easy to calculate. I looked at a deal last week. It didn't have it. You just take the net operating income that they have in there and you divide it by the purchase price, and that is your going in cap rate. Another important metric that I like to look at is the reversion cap rate or the exit cap rate. So if you're going to buy the property at X cap rate, what cap rate do you assume that you can sell it? We like to put a spread in there, right? If we sell it at the same exact cap rate that we bought it and we boost income along the way, great, we're going to hit a home run, right? But if we assume that the income stream that this property produces is going to be valued a little bit less than when we bought it, it's going to give us some breathing room, right? So if the numbers look good with a little bit more of a spread, they're going to look awesome if we sell it for the same or a lower cap rate. So we like to bake a spread in there for sure in our assumptions. Another thing that's really going to affect these assumptions are the assumable rent growth. And right now, I think in Houston, it's pretty standard that people are just doing like straight threes. 3%, 3%, 3%, 3% year 1, 2, 3, 4, and 5. That's fairly standard in most of the deals that I'm seeing. But even though Houston last year, the rent growth was 4.9%, right? But we expect Houston to slow a little bit. So if you're going to assume 4.9% throughout a 5-year period, that's going to be a little aggressive on the assumption. So we're going to say, hey, look, no one has a crystal ball. And in reality, it may be 3, 2, 5, 6, 4. No one really knows what's going to happen 5 years from now. But if you assume more of a conservative growth versus a robust growth, if you hit the robust growth, great. That's just going to be icing on the cake. If you don't, then you're insulated. Same with pro forma rent. You're going to see some comparables in there. And, if somebody is going to buy an apartment complex that is, that a unit is leasing for $800 and they're going to make it much nicer and lease it for $1,300, that's a $300 rent premium. So can they prove it to you? Can they show you a property in the area of the same vintage and of the same style that is achieving those rents? And they should try to prove it to you in the business plan. You'll also see some type of other income increase, and sometimes this number is extremely large, and I'm going to ask, like, okay, how are you getting this number? And often they're getting those from fees, maybe from Wi-Fi, maybe they're putting washers and dryers and renting them out. Make sure that they can get to that number for you and make sure that their explanation satisfies you. And last but not least, especially in Texas, what are people assuming for new tax valuations? You can't buy a property and assume that you're going to be paying the same taxes as the last owner. It's just not the case. We have a tax professional that looks at all our deals as we're submitting LOIs, and he helps us to estimate it. And that team, including their tax lawyer, has strongly recommended in Houston, our baseline assumption is 90% of the purchase price. If we can get you less, that's the goal, great. It's icing on the cake. In Travis County and Austin County, 95% of the purchase price, that's what you're assuming. You can't just assume that you're going to pay. If the seller bought this property for 10 million and now you're trying to buy it 5 years later for 15 million, even though it's likely worth 15 million, you can't assume that you're going to be paying taxes on the 10 million, right? Like he was. That the county's going to come and they're going to be collecting after this transaction for sure. Okay, so we're going to switch. I'm going to stop this share. Move this thing here, and we're going to switch over to a different screen here. We're going to switch over to, one second here. Okay. Okay, can everyone see this underwriting model? Hopefully so here. If anyone can't see it, or just please put in the chat maybe if you can see it or not. That would be extremely helpful. Or in the Q&A. Okay, so I'm going to assume everyone can see this. Okay, so let's see, Manu, what's up, bud? Here we go. Do I need to zoom it? I'm going to text you, Manu, because I can't. It's not letting. Okay, so what we're going to do here is I'm just going to run through this quick underwriting model just so I can show you some of the assumptions we just talked about on that last page. Okay, and so right here we have this 300. Okay, the chat's disabled. Okay, sorry about that. Yeah, chat is disabled. Can see it well. Perfect. I appreciate it. So right here, so this is a dummy deal. It's not a real deal. It's a 328 unit property in Houston, Texas. It's a 2014 build. And we're going to make an offer on this property for $48 million, right? So remember I talked about the going in cap rate, right? So the going in cap rate is clearly listed here. It is a 4.56 cap rate, right? Now, one caveat is last year, if you would have tried to buy this at, let's say in January, this would have been a 4 cap. In other words, with much higher values, right? But since cap rates have unwound a little bit, this is going in at a 4.56. And some people might even say this is still low for the Houston area, but this is a newer deal. It's very big. And it's very nice, right? Let's hypothetically, right? So if you come down here, this is a 5-year hold period or 60 months. And our terminal or our exit cap rate is 5%, right? And so we're giving it some spread here, 44 basis points from 4.56 to 5%, right? And so that's going to give us a little breathing room, right? And you see up here in the right-hand corner under partner returns, under LP returns, the cash flow, cash on cash return is 6% annually, and the internal rate of return is 15%. The equity multiple, for those that don't know what it is down and dirty. Let's just drop the 1. The 1 means you got your money back. If you didn't hit an equity multiple of 1, you lost money. You made money, and this is a 90% return over 5 years, right? Or about a 17% average annual return. All right. So this is our baseline case right here. This is the baseline assumption that we're going with, and that we're going to market this deal to try to find investors. Now, let's say hypothetically we sell this at the same exact cap rate that we bought it at, right? So let's just change this to 4.56. The market's hot. We knocked it out of the park here. So the cash on cash stays the same, but the IRR boosts almost 3 percentage point. The equity multiple, you just earn 23% more just by this one market driven metric here, right? And so we're going to switch it back to 5%. All right, and you're going to see how that IRR changes just from that cap rate. Now, let's just hypothetically say the market is doing terrible, right? We're in the middle of a recession. It's very, very hard to get lending, but we really need to sell this property because our loan is coming due and there's really no option, right? So let's just say 5.5% is the cap rate that we sell it for. Okay, and now you can see the cash flow stays the same. The IRR drops almost 3 full percentage points, and you're only getting a 68% total return over the 5 years, which, if we're in our pro forma, if we're estimating a 15% IRR and a 90% return, and you get a 12 and a 68% return, maybe you're going to think we didn't achieve our goals that we set out, and we didn't, right? But even if the income was high on this property, here it was just a market driven. So kind of a review is that we like to see the spreads here. We don't necessarily love to see, a going in cap rate of 4.56 and an exit cap rate of 4.56, because that's really not giving you any cushion. If the cap rate is a little bit higher, then you're not going to hit your returns, and then the investors are going to be upset. So we're always going to put some spread in there. Let's see here. We're going to hit the scenarios tab here. I'm going to zoom here a little bit here. Okay, perfect. And so as we said, the base case assumption here in Houston, Texas, we're going to just do straight threes across the board, knowing that it's never going to be straight threes. Nothing's ever going to be perfect, right? But let's just say we drop this to a 2%, right? Straight 2%. You're going to see how the returns change, right? So it goes from 15 to a 12.29, and the cash flow drops, right? Because you have less income coming from the property. In actuality, it's probably going to look more something like this, right? Let's say year one, things are struggling a little bit. We're evicting a lot of people. Year two, let's say, we're getting some momentum. Oh, not 300, 3%. Okay, year three, we have momentum. We've turned all the units, all the rehabs are done. The economy's good. Right. And then let's say we just go threes after that, right? So this is probably maybe a little bit more realistic scenario, but no one has a crystal ball. So if people are jumping all over the place with their assumable market rent growth, they're just completely guessing. So I think it's pretty standard to see maybe a little pop at the beginning, especially if you're doing some heavy rehab, and maybe the market is flying. Like say in 2020 and 2021 in Austin, easily I can see people putting 5 or 6% rent growth years one and years two. But right now that rent growth has throttled quite a bit over there just with all the new supply. And so you wouldn't want to see like straight sevens, straight nines. That's going to be super aggressive in their assumptions. So we're going to kind of go back to base case here. Okay, base case. And that, this is the same thing with expenses, right? If our expenses shoot through the roof and stay through the roof with crazy inflation for 5 years, and let's say our expenses are 5%, it's going to, as the expenses increase, your returns are going to decrease, right? So we're going to go look at a couple more things here. I don't really want to get bogged down in the underwriting. I just really wanted to kind of tee in on how exit cap rates affect your total return profiles, because they say a spreadsheet lies more than someone out of their mouth, right? So you can really get these spreadsheets to tell you what you want if you just change a couple of cells, and that's kind of what we want to make you aware of. And you should ask sponsors, how did they come up with some of their numbers, right? How did you get your exit cap rate? How are you assuming your rent growth? These are all legitimate questions that, anyone that's buying a $48 million deal, they should have very quick answers to these questions, because a lot of thought goes into buying these properties before you just pull the trigger and buy them. So I mentioned the taxes. And so right here in our underwriting model, you're going to see this is a Houston deal. We're going to just automatically assume that we're going to be assessed, our new valuation is going to be around 90% of the purchase price, right? And so this number here is 90%. You see we're at our baseline returns of 15%. So let's say hypothetically, we go in and we sue the county, which we will sue the county. We will take them to litigation if we need to, if the evaluation is crazy. And let's say in the litigation we win and it's 80%, right? So that's going to boost your returns by, now we're 2xing the money. Instead of a 90% return, it's 100% return. We've increased the IRR by 1.5%, and so that's a good thing. But let's go back to where we were at 90. Let's just say we lose the case, and we're taxed 100% of the purchase price. That's going to hurt it, right? So less cash flow. We lose 1.5 points on the taxes. And so that's why it's important to have not be so aggressive, right, on your assumptions. That 90% is what the guy that we pay to advise us on taxes, that owns a commercial tax firm. Just like you're getting people to protest your taxes, we pay a commercial person that only focuses on commercial properties to protest our taxes. And this is his recommendation, and he's a paid consultant of ours. Yeah, so we'll go back to 90%. And the last thing that I think is extremely important to ask, especially in Houston right now, is your insurance quote accurate, right? Because as you can see in this property, we're estimating $850 per unit. Now, at the beginning of last year, this would have been $600 to $650 per unit. So that's already a 30% increase that we're baking in. We're seeing some people right now that are not on master policies. We're getting some quotes, just some one-off quotes from companies it's like 13 to 1,500 to even 2,000 per unit in like areas like, let's say, Deer Park or something like that. So that is a little bit more, that a little bit closer to the coast. So let's say we get this deal under contract. We're already raising money for the deal, and the insurance provider comes back and says, "Oh, you know what, 850? No, that's not going to work. It's really going to be 1,300." So that's going to significantly, it's going to 2 points almost that you lose, almost a point in cash flow, 2 points in IRR, 13% less of a return. So you'd want to ask, especially for any Gulf Coast deal. So let's say Florida, Alabama, Louisiana, Mississippi, Texas, any Gulf Coast, maybe even Georgia. You're going to want to ask the sponsorship, hey, look, is this just an assumption on the insurance, or have you actually talked to an insurance broker and they gave you a firm quote on the insurance? Because that can really blow the deal up, honestly, is the insurance. And people with existing deals right now are really getting blown up on the renewals, unfortunately, just because, they're used to paying, 600 to 850, and now their renewals are 1,000 to 1,200. So it hurts the cash flow, at least temporarily. If we can go a couple of years without having a major hurricane on the Gulf Coast, we expect insurance to come down significantly. But several bigger vendors have left the space, and so that's overall just putting pressure on getting insurance of these bigger properties. So I'm going to close this model now, and I'm going to open back the presentation. We have a couple of more slides, and we'll be done. Okay, so this here is a case study. This is the two deals that I looked at this past week. They're in the same metro. It's a metro that's not as good as Houston, and about 4 hours north of Houston. It's the DFW. Two extremely experienced sponsors. These deals were not in the same pocket. They were actually in different towns, but they're very, very similar. Deal one, it was a 1980s deal, 120 to 140 units. The going cap rate is 3.3, and the exit cap is 4.5. So you see quite a bit of spread here, right? So this is a 120 basis points on the spread. But just kind of looking offhand, without even looking at the pocket or the deal, I would say a 3.3 going in cap rate for like a B minus, maybe a C plus, B minus deal, even in DFW, seems a little aggressive to me. I know right now I wouldn't be buying a 3 cap in Houston. And that's just my opinion. He does give it a spread, but you can see, I mean, even the exit cap is pretty aggressive, even though, I don't know that much, I don't see a ton of stuff moving in DFW these days for less than a 4.5 cap, but, overall fairly aggressive here. Now you can see a little bit different town. I would say maybe not as a desirable pocket, but 1980s, same exact size, going in cap rate is a 5, right? And so the valuation of this income stream that he's buying from this property has a lower valuation, right? So he's getting it at a better cost basis, and he did put some spread in there. He put a little bit less of a spread at 50 basis points. Again, both super experienced operators, thousands of units, but it was interesting. Same metro, one is super aggressive buy, aggressive on the sale. One, I would say, less aggressive buy, less aggressive on the sale. So those are things that as you start looking at these deals, just by looking at the investor deck, you can kind of look at a couple of numbers and try to understand the differences. And the more deal flow you have, the better, because you start seeing these things and you start just seeing patterns and you start understanding like where things are trading at. Okay, so shifting from the underwriting assumptions to fees. I mean, you're going to see some type of fee structure in these deals. Fees are normal in multifamily syndications, or really in any syndications, right? That's how people get paid. Most of the cash flow on these deals go to the limited partners, and the general partners may get some kind of fee at the beginning, some type of acquisition fee. I'd say 1.5 to 2% is pretty standard. If you've been doing it for 20 years and you have this track record where you've bought and sold 20,000 units, maybe there people are pushing 3%. An ongoing asset management fee just to help with your payroll, maybe 1.5 to 2%, and then a construction management fee. All those are extremely normal fees that you're going to see in deals. What I personally don't like to see is a skinny deal and maybe even a riskier deal with lots of fees. And what I mean by that is, let's say just an example deal, you get a deal sent to you, the cash on cash is 5%, the IRR is 12, the average annual return is 14%, not terrible. And you looking at it and say, okay, this is a class A deal, maybe in Houston, great. Maybe that's reasonable. However, if you look at the fee structure, it's a 3% acquisition fee, it's a 2% management fee. When they sell it or dispose of it, they want a 1.5% fee. If they decide to keep it and refi it, they want a 1% fee. They want a 1% fee to the loan guarantor. So if you look at all these fees, I mean, this is extremely fee heavy deal without really giving you that great of return. You could reduce some of these fees and share the wealth and maybe boost this IRR to 14 or 15 to where everyone shares. And so this is what I don't like. So kind of in a nutshell, fees are normal, but if they're going to fee you to death and not really give you that great of a return, for me, it's a hard pass. So questions to ask. I mean, it's your job when you're talking to sponsors, especially when they have a deal and you're looking at investing in their deal. You should be interviewing us, and we should be interviewing you, because for us, we don't want an investor that doesn't really understand what they're putting their money into, and then maybe has regrets at some point down the line. We want you to know exactly where you're putting your money for exactly for how long the business plan is going to be, right? And just because we say it's going to be, let's say 5 years, and if we're in the middle of a recession and it's year 5 and we need to sell, but we say, hey, you know what, we're going to extend this loan and keep it another year or two. It's cash flowing, it's doing well, but we just don't think it's the right time to sell. That may happen, but we all want to be on the same page. So you need to know how much the team is investing, right? Are you putting your money where your mouth is? Do you have skin in the game? Is your family investing in the deal? My wife personally invests in my deals. My sister-in-law invests in my deals. And so, I'm not going to pitch a deal to you that I wouldn't personally invest my own money into. I would always ask about explain to me a challenging deal. And right now you're seeing a lot of people with challenging deals right now, right? If you bought a deal in 2021, depending on what type of debt you get, maybe you're hitting a little bit of headwinds with your business plan. You would want to know, have you ever done this? And it's the same as like picking a surgeon, right? Do you want a surgeon that's never seen a complication before? No, you want someone that has dealt with challenges before and has found their way out of challenges. Does the team have experience in the market? This is a great one. For us, it's easy. In Houston, we know hundreds of vendors, hundreds of contractors. It's easy. You're moving to a completely new market. Your Rolodex is going to be very skinny until you can get established there. And so that's definitely going to affect you. You're going to be 100% relying on your property manager. And maybe they have their preferred vendors, and maybe their preferred vendors aren't the best vendors. And so experience in the market definitely matters. Have the budgets been verified? If you are using a third-party property management company, they're definitely going to give you some type of pro forma and tell you, hey, this is to our best knowledge, this is what we think it is going to take. This is the income and this is the money that it's going to take to run this property. Doesn't necessarily mean it's going to be perfect budget every time, but you have to have someone else verify your budget, especially if you have a third-party property manager. Again, I'm going to hit the insurance quote and the tax professional. What's their professional opinion? So, do you have a quote in your hand, and is it a solid quote? And what are you going to assume the new tax hit is going to be? Another important one that I like to ask is, are distributions a return on or a return of capital? It's very common to see these days. Let's say in this project right here, in this fake project, it's a $25 million raise, right? And that includes the down payment, and that includes the rehab. But you'll see some groups, instead of raising 25 million, they'll raise 27 million, right? So an extra 2 million. And what they're going to do with that is that's going to give them a little breathing room. Say if their project hits a little headwinds, we're in the middle of a recession, something happens, it's not going to hurt to have an extra $2 million in your pocket to kind of get through some rocky times. However, eventually they start releasing that money back to the investors. Let's say you get through the first year, everything's trucking along, everything looks great. Okay, let's start distributing this extra money to the investors and just giving it back to them. For me, I want that to be a return on my money. I don't want them to just be giving me my money back, right? I want that to be an actual return, even though it's not income that the property is producing. I want it to be a return on my money, meaning that I'm going to get my money back later. This is just an actual real return, not just giving me the money back. Our deals and most deals these days have some type of preferred return, meaning, like for instance, our preferred return on a baseline $50,000 share is going to be 7%. You want to make sure that accrues, right? If we don't hit 7% year one, let's say we hit 3% because we're in the middle of heavy construction, then we owe you 4%, and we're always going to be on the hook on that 4% until you get paid. And so you want to make sure that accrues. I would say most preferred return deal structures these days accrue. I haven't seen a non-accruing one in quite a while. I would always ask the sponsor, like, is there multiple ways to exit the deal, right? Is this a 5-year hold and we can't get out until 5? Or if the market is hot, can we sell this thing in 3 years? You want multiple exit strategies. If you need to pivot and you need to sell it quickly and take advantage of it, then I want to be able to do that without getting hit with a huge penalty. More questions. Again, similar, the debt, when can we exit? Some of these loans have significant prepayment penalties. And so you want to make sure, if it's a 5-year loan, but the sponsor is saying, hey, we may sell this at year 3. Okay, that's great. But is the prepayment penalty, is that included in your underwriting? Because if we can sell this in 3, but we have to pay a $2 million penalty and it hurts the returns, then we're going to have to hold it for 5. So is it a real return? And so I would always ask that, is the prepayment penalty included in your numbers? Another question on debt is like, how long is your rate cap? Floating rate debt is very common in some of these larger projects. People are getting squeezed just because interest rates ran up so much. If you have some type of rate cap purchased, then you're somewhat protected, not 100% insulated, but at least there's a cap on how much you can go. So you'd want to ask, like, how long is that cap for? And do you have factored in buying another cap once this cap expires? And last but not least, did you model a refinance? Like, refinances are great. I kind of live by the mantra, especially on the smaller properties that I do personally, is refi till you die, right? If I have equity in that property, I'm going to be trying to either sell it or I'm going to be trying to strip the equity out and getting a new loan on it so I can take that money out and reinvest. So refinances are great. But what if you can't refinance, right? Like right now, there are very few people pulling off successful refinances, at least at this day and age. There are some. I know a guy that did it in Houston this week that pulled one off and it was great. But a lot of people that thought they were going to get cash out of their refi are actually having to put some cash in to do the same refi just because the value is not there and the cap rate has expanded some. And so if someone models a refi, just know that is another assumption that they have to hit on, right? So not only is and I'm not saying refis are bad at all. I mean, it was very common for almost every deal to have a refi modeled in, like at the beginning of last year, the year before that. Very, very common when it's easy to get loans and money's cheap. But I'm seeing less and less refis modeled, at least at this point in the market cycle. And just be aware that a refi is an assumption. So I would say if you see a refi in there, just say, hey, what gives you the confidence to think that you're going to refi? And they should have at least some type of explanation, because it should be a well thought out decision that they made. So thank you. I promised to make it quick. It's been 45 minutes, so I did run over a little bit. Is there any questions? It seems like most people stayed on, which is surprising. It looks like I didn't bore everyone to death. Let me see here. Let me stop the screen share here. Any questions in the Q&A? Oh, there was one. Who needs to verify the accreditation before investing? So if we have a 506C deal that we're marketing, and we do use a third-party accreditation company. And so let's say if you're going to be accredited by income, then they may need you to submit, let's say, your last couple of W-2s or your tax returns to basically prove that, yes, I am accredited based on income. So yes, we do use a third party. Okay, so if there's no other questions, I'm going to call it a night. Again, greatly appreciate you being here. I hope you learned a little something in the 45 minutes that we went over this. If you have any other questions, let's see, is there another question here? Great presentation. I appreciate it. If you have any other questions, we're an open book. If you haven't talked to our team, feel free, go to our website, www.genwealthcapital.com. You can book a call with me directly from our website. Again, if we have a 506B only deal, it doesn't matter if you're accredited and you make $1 million a year. If you haven't had a conversation with us, if it's not documented in our CRM, you can't invest, unfortunately. That's just the rules and the regulations of the SEC. And so, but we'd love to book a call with you. We'd love to have you for happy hour. So, don't be a stranger. Feel free to reach out to us. Have a great night. Thank you.